With the news so dominated by stories about inflation, market turbulence and tariffs, speculation about a forthcoming global recession is increasingly hard to avoid. But what is a recession? A recession is a period of significant economic decline in any economy, typically defined by a contraction in real GDP for 2 consecutive quarters or more. During a recession, economic activity slows down, leading to a reduction in production, employment, income and spending. Businesses may cut back on investments and hiring, and consumers tend to spend less, further deepening the downturn. Recessions are a part of the economic cycle and occur with relative frequency. Sometimes they are isolated to one country or region, and others are global. But how do we know when a recession is coming? Whilst every situation is different, there are a number of key indicators that economists rely on to warn of an oncoming contraction. These can range from a decline in GDP, rising unemployment, reduced consumer spending, reduced inflation or even deflation, and decreased business investment. But what causes this to happen? Recessions can be triggered by a variety of factors, and as with anything in our increasingly integrated world, often a series of co-occurring phenomena around the world coalesce to make one happen. A sudden decrease in consumer demand or business investment can cause economic activity to slow down. An obvious example here would be the coronavirus pandemic, when many businesses saw demand for their services disappear overnight as lockdowns forced people to stay at home. Disruptions in supply chains, for example oil price hikes, can lead to higher costs and reduced economic output. In 1973, OPEC imposed an oil embargo on the United States and other Western nations in response to their support for Israel during the Yom Kippur War. This led to a sharp increase in oil prices, triggering inflation, reduced consumer spending, and ultimately a global recession. Banking crises or stock market crashes can result in a loss of wealth and confidence, reducing spending and investment. Think Wall Street crash or the 2008 credit crunch. Central banks may raise interest rates to curb high inflation, which can slow down borrowing and spending. The 1981 Volcker shock in the US is a good example of this. In addition to the dreadful human cost, wars, natural disasters and pandemics can dramatically disrupt economies and lead to recessions. So what, if anything, can be done to minimise the damage? Whilst governments don't have the power to end a recession at will, they can enact measures to try and limit the damage and expedite the process of returning to growth. In many ways, tax cuts are just another way of increasing the amount of money circulating in the economy. By reducing taxes, governments essentially boost the spending power of businesses and citizens by taking a hit to their own revenues in the hope that this stimulates the economy. Governments can increase spending on capital projects and other initiatives to boost demand and create jobs. Economist John Maynard Keynes is most commonly associated with this idea. This, along with tax cuts, form the bedrock of Keynesian economics. QE is another means of increasing the amount of money circulating in the economy. Whilst it's sometimes referred to as money printing, in reality central banks increase their purchasing of assets to boost the volume of money in circulation. In capitalist economies, recessions are seen as a natural part of the economic cycle, but they often have profound social consequences. They lead to higher unemployment, lower consumer confidence and business failures. Whilst governments often don't have the power to stop a recession through timely policy intervention, they can accelerate out of one. Thanks for watching.